Hello and welcome. You're tuned into Business Today TV. I'm Sakshi Batra. Well, the festive season is upon us, and as we get ready to usher in a new Samvat, what is it that will make you a lot of money in stock markets? Well, to answer that, I'm joined by a market expert today. Gurmeet Chadha joins in. He's the founder and CIO at Complete Circle Wealth. Welcome, Gurmeet, and here's wishing you a very, very happy and a prosperous Diwali.
Thank you. Thank you, Sakshi. Wish you and everyone tuning in the same. A very happy Samvat and a lot of wealth creation ahead.
Absolutely. Well, thank you so much, Gurmeet, for taking the time out for being with us on this Diwali special. To begin with, first you tell me, do you make it a point to invest every Diwali, and how auspicious is the occasion for investing in markets?
So, I'm a lazy and boring investor. So I invest every month irrespective of any festival. But since in Diwali, you use the occasion to clean up your household, you decorate things, you meet a lot of people, you do a lot of gifting. If you apply a bit of logic to investing as well, while there is no, good day to do good things, but maybe it's a good time also to, clean up some of your mistakes. A lot of us always talk about, our learnings, our earnings. We rarely talk about our mistakes. So, maybe you can use this to get rid of some of the mistakes, clean the portfolio a little bit, rebalance it. Just make another new beginning. This is a long journey ahead. So don't just look from one Diwali to another. India will probably have a bunch of good Diwalis in next 5-7 years.
Absolutely hoping for the same. And that's a great way to start off with. Clean up your portfolio and do some new beginnings at that. But do you remember which was your first Diwali pick at all?
Yeah, the first Diwali pick was HDFC Bank way
Okay.
back 14, 15 years. And I got that in form of ESOPs when I was working with HDFC employee, and then I vested some of them. So that's the first Diwali pick, and it's been a real cracker in last 15 years, despite last 2, 3 years being slightly subdued.
Right, absolutely. So now talking about Samvat 2079, the last Samvat has been full of a roller coaster ride. We've actually seen ups, downs, whatever could go wrong perhaps has gone wrong. But the brighter side is that the Indian markets have remained resilient when you compare it with the world as well. Going forward into the new Samvat year, what are your expectations? What can investors looking to potentially start their journey in this Samvat, what should they be prepared for?
I think that's a good beginning to start the conversation. I think we probably are heading in, the times have been very turbulent in 2022. There has been war. We were just coming out of COVID. Nobody thought inflation would be as high. I mean, who would have thought, the inflation would be double digit and dollar would strengthen so much against most currencies. So I think we are in a tough environment, and despite a tough environment, India I think has done relatively well. And outperformance is not just always going up. Outperformance is also falling less, and that's a very important aspect of market. If you fall less, you tend to grow better. That's because we usually start with returns, but I think you should start this somewhat with risk. There are a lot of risk around, but if you measure them well, diversify enough, those risks can be mitigated. So start with having a very balanced outlook on the market. After a long time, you're also getting fixed income yields at 7.5%, 8%. I've not seen a 7.5%, 8% bond, but at least for the last 4, 5 years, as I can recollect. Overseas, you're getting dollar bonds at 4.5%. So have some portion to fixed income. I think it not only will give you stability, but also will give you, now decent returns, at these levels. Also, in this kind of market, don't overpay. Don't just buy what is in fashion. Don't just buy what is too much in news and what everybody is doing. Pay a reasonable valuation, because what happens is when interest rates go up, the price earning multiple contracts, and we have seen just the reverse in last 8, 10 years, because interest rates were so low. We have seen PE
Sure.
expansion. Not many of us have seen PE contraction, especially the young investors. Right, so pay a reasonable valuation to, even if it's a great company, don't fall in love with it. Be objective about it, and also at the same time, if there is lot of short term noise, you have to go level two and look at business performance over price performance. So
Right.
if you are a little more patient, you're doing a little bit of work. I think there are still good returns to be made.
Absolutely, and hoping that there are much better returns to be made as we go forward from here. But keeping in mind that the last 2 or 3 years have been extremely challenging, not just at the macroeconomic level, but at personal level, at humanity level as well. But at this point in time, what happened was a flurry of new investors really entered into the stock markets for the very first time. There was a lot of time at hand. There was extra disposable income. People could not spend it, but those investors have come into the markets who have no prior knowledge about or have not seen any ups and downs in the markets. This perhaps has been the first year when they've seen flat to negative kind of returns. What would your advice be to them, say, as they begin this new summer with the mixed feeling?
Change and fluctuations are integral part of life. Forget about investing. If you check your pulse every hour, you have different readings. If you are a runner, probably you clock different timings. You are a
Mm.
batsman, sometimes you score a century, sometimes you get out on a duck. So I think change is the essence of life, and so is investing. I think so. You can't. This is
Yeah.
not the last correction. This is not the first. This won't be the last. But what you do in downturns, what you do in volatile phases determines your return in up cycles. So that's something has to be kept in mind. So don't track returns on a daily, weekly, monthly basis. Track returns on a block of maybe 5, 7 years if you're a long-term investor. And while I give you an interesting data, Sensex for last 40 years is roughly about 13-14% CAGR, right? But there have been only three
Okay.
years where the return is 13-14%. So 13-14 is the average, which means that there are years where it does very well and where there are years there are negative returns, years like this where
Sure.
it is still flat. So I
Sure.
think you have to, the returns are non-linear, but in a block of 5, 6 years, I think India has always done well. I've not seen anyone make negative returns over a 5, 6 year, at least in my 20-year journey. So have that orientation in place. And at the same time, have modest expectations. This is not the place to get rich overnight, get rich quick scheme. This you have to grind yourself, show a lot of patience when you invest, and research well, study hard. And if you don't want to do anything, just be a passive investor, just do index investing. You should be fine.
Absolutely. Well, you gave that caveat right in the front that this is not the place to become rich, because that's the frame of mind with which most of the millennials at least are approaching the stock markets at this point in time. That, quick making a quick buck is the thought process behind it. Since you said that, one should have moderate expectations, what is the reasonable expectation that one should have from equity markets this year? Can we see at all double digit returns? I'm just talking about, hoping for the best.
No, no, absolutely. I think, as I said, I don't see. So India's returns, if you see again, index returns has been 13-14%. So has been a nominal GDP growth. Even this year, in a tough year, you're talking of 6.5-7% GDP growth and perhaps 6-7% inflation. So which means that we will still do 13-14% nominal growth. I think if you just fast forward a little bit, Sakshi, 27-28, even IMF is saying India will be the third largest economy at 5.7-5.8 trillion dollars, which means if you take market cap to GDP as 1:1, you will have a $5.5 trillion market cap, which means more wealth will be created in next 4 years than it has been created in last 60, 70 years, right? So which
Yeah.
clearly means that, on a 4 or 5 year period, we are really looking good, as an economy. Now, how do we invest? So the next growth of GDP from 3 to 5, 6 trillion would be more knowledge, would be more financial inclusion, would have a higher share of manufacturing, would have a higher share of digital. So that is how you need to, so this is how every developed economy does. Every trillion it adds, every next milestone it reaches,
Sure.
the complexity, the efficiency increases, right? And that's how you have to be focused. And that is what India is seeing now. Look at this year. I mean, Nasdaq is down 32%. S&P 500 is down 25%. Hong Kong market has given up last 12 years of gains. China has been in a bad spot for last 12 years, and Nifty is still flat. So
Yeah.
that's a lot of resilience. And since you spoke about millennials, we had 3.5 crore demat investors pre-COVID. We have 10 crore demat investors. We have another 1.5 crores new mutual fund investors. So I think
Sure.
this participation is structural, and we are after a long time, as Dilesha says, we are getting our ownership of equity back from foreigners. So I think this trend will continue.
Absolutely. Well, talking about the trends, where do you see the next mega trend really emerging in the markets? Now, people are talking about manufacturing, there's the defense theme, there's the capex cycle everybody is focusing on. How are you looking at which would be the big themes that one should be keeping in mind the next fiscal or the next somewhat?
So, I concur with you on manufacturing since you raised that point, Sakshi. So, manufacturing, if you see, I think the current share to GDP is fallen to about 15%. I think we will gradually be now getting towards closer to 24-25%. Government officially has a target of 25% manufacturing contribution to GDP. I think we will get somewhere close to, if not exactly 25%. And it is coupled by a lot of factors. It is coupled by China plus one and now Europe plus one, import substitution, PLI schemes, we becoming more competitive, our digital infrastructure. There are a lot of factors which have gone into it now, and we are seeing clear uptrends in few pockets. So let's take, for example, electronic manufacturing services, which we called EMS. India's share is likely to go up from $75 billion to almost $250-300 billion. Now that's like a 4-5x jump over the next 4-5 years. And EMS basically is it covers mobile manufacturing, electronics, consumer durables, telecom equipment, etc. There are a couple of good companies which have done a great job in it. Dixon is one of the examples. There is Amber. There are so many. And what is happening is we were earlier, into labor arbitrage, more assembling, more as our units were more for assembling. Then we moved into original equipment manufacturing, where you actually design, make the product as per the original design of the innovator. And now we are getting into ODM, which is called original design manufacturing, where you actually design it and somebody takes your labor. To give an example, the LED panels you see and the laptop panels you see for Dell are made by Dixon. A lot of mobile handsets you see by so many large, mobile operators is made by Dixon. Also, a lot of big companies are setting up your manufacturing base in India. Look at Apple now. We have already started iPhone 14 manufacturing in India. In fact, there's a JP Morgan report which says that 15% of the iPhones could be made in India. Within then, manufacturing, we have defense, we have chemicals. I can go on and on, but in interest of
Sure.
time, I'll cover defense also since we spoke about it. I think this is a
Yeah.
huge opportunity. Today morning, the army chief talked about 8 lakh crore worth of domestic defense orders coming our way in next 5 years. That's huge. And so the mix of indigenous and foreign is changing. It's already changed in last 2-3 years a bit. I was in Defense Expo 2 days back, and I was quite surprised by the kind of innovations we are doing, the kind of rush and inquiries I saw in a lot of counters. So we tracked something like an HAL, Solar Industries. HAL for users is more into lightweight helicopters, Sukhoi, it's fighter jets, aero engines, etc. That's primarily what HAL does. Great order book, both in 2 year segment and 5 year segment. 60% comes from repair and maintenance, and another 1/3 comes from manufacturing and development. So great product mix as well. Another company we track is Solar Industries, which earlier was only into industrial explosives, which they are doing very well. They have 70% market share in exports as well, and now they're getting into defense in a big way, supplying hand grenades, rocket ammunition, aerial command center, drones, and closely also working with ISRO on some of the satellite technology. So there are a lot of companies there. There are a lot of ancillaries also. These are some of the HL is the largest defense PSU. We'll find a lot of defense ancillaries also. This is something which we think could probably be very, very disruptive.
Okay, so those are the broad themes that one should definitely keep in mind as and when the long-term portfolio thinks of creating and constructing in this new Samvat. But on Diwali, there's always investors are looking for some stock recommendations or stock picks. That's very popular among all the investors. But I want to understand from you, since you're not going to be giving any recommendations, but help me understand if there are any top 5 or top 6 stocks that are on your high conviction list that investors can definitely start researching about and start looking if it suits their portfolios too.
So I can talk about top five or maybe our high five conviction ideas in our portfolios where we are invested for long term, with a
Sure.
disclaimer that we are invested through the PMS route. So continue to like private sector banks. You see, just got a cracker of a result Axis Bank had yesterday evening, just showing that now probably the turnaround which Mr. Amitabh Chaudhary started, when he took over, seems to be now bearing fruits. The net interest income went up 31% year on year, 10% quarter on quarter. The NIMs expanded, net interest margins expanded, the credit cost got lowered, the asset quality improved. This is a perfect cocktail for a bank when you grow credit aggressively, your asset quality is improving, you have lesser provisioning, and your margins are expanding. That's how the profit growth comes. And that's how you see the reaction of the market today. So Axis now is doing what ICICI has been doing for the last few quarters. Again, another turnaround story one can look at. So I think banks tend to do better. So not only the credit growth is good, I think you're seeing the bank balance sheet at its very best. The asset quality is now on a, we've seen a lot of cleaning up already. You can also look at some of niche financials, which is you spoke about youngsters, millennials participating. So one proxy way of participating in the market is CDSL and CAMS, which are nothing but duopoly players. CDSL is the largest depository, CAMS is the largest RTA agent. So that's one way of growing, retail participation in the market. So I like financials. I think the profit contribution to Nifty would be the highest by financials, almost maybe 50-55% EPS growth could come from there. We like manufacturing. I discussed solar with you and Dixon with you. I also like some of the,
Yeah.
right now, some, being a little contrarian here, it is when there is problem is when you get stocks 30-40% cheaper in IT. And I think right now we are going through a bit of a turbulent times because obviously of issues in US and Europe. But, companies like Infosys, TCS, they've seen it all in the last 20 years. They've seen a dot-com bubble. They've seen a Lehman crisis. They've seen Fed taper in 2013. They've seen COVID. I think the tech spending is no longer discretionary in a lot of verticals now. And somebody actually told me that technology is not a vertical, it's a horizontal now. So it's encompassing everything, right? So just to give you an idea, cloud, the migration is only 22% right now. So I think we are long, just to give you an idea. So I think good technology companies at reasonable valuations, if you have a little patient and can withstand 2 quarters of volatility, I think the risk is okay.
Okay, so financials, top financial names right there as high conviction names, which Gurmeet has been investing over the years, and we've seen those stocks really definitely give great returns over a long period of time. Then technology as a contrarian bet, and of course the defense and the ancillary defense themes. That those are the names that Gurmeet is really comfortable with. But what about names like ITC that have been complete outperformers? I thought you would talk about those also. After the earnings also, we've seen the coming of age perhaps of ITC from those meme fests that we've seen in the recent past. To talk about those as well.
I think stellar set of numbers. I think not only the cigarette volume surprise. I think they've done well on the FMCG business, the paper business completely doing well. There are talks of already the hotel business getting demerged or hived off. So not only the operational performance has picked up, so there is pricing growth, there is volume growth. Uh, there is better capital allocation is what people think like with at some point of time the hotel and even FMCG business hopefully will get demerged. So there is value unlocking opportunity there. And despite the run up, it's one of the cheapest consumer stock. You have most of the FMCG names at 50 earning multiple. IDC despite this run up is still 25 times probably. So I think and generates 15-16 thousand of crores of cash flows. Like one thing I've learned, whenever you are confused, look at the cash flows. This is where the real money is. So if you don't know what to do, one parameter you should stick to is steady cash flows.
Okay, understood. Well, on that note, thank you so much, Gurmeet, for being with us and sharing these wonderful insights about markets, how to approach it as we enter summer 2079. And here's hoping it becomes a very profitable year for all of us right here. Season's greetings to you yet again.
Thank you. Always a pleasure. Happy investing.
If you like the video, do like, comment, share and subscribe.